What if I told you that one of the absolute biggest problems with scalping is that traders just make it way, way too complicated? We're talking too many indicators, too many setups, and frankly, just taking way too many trades. Well, welcome to this explainer. Today, we are stripping away all that noise. We're going to break down a brutally honest, much simpler truth. Sometimes, the most effective and profitable trading strategy is honestly kind of boring.
Now, you've almost certainly seen those flashy titles online, right? The ones screaming things like, "This strategy made me $22,500. Look, it's designed to grab your attention. But before we go any further, we need a massive reality check. A profit result from one trader on one account during one highly specific time period, that means absolutely nothing if you don't actually understand the underlying mechanics. Markets change constantly, your execution matters, and losses are quite literally an inevitable part of trading. So instead of getting distracted and chasing that clickbait $22,000 number, we're going to focus on something so much more useful. We're focusing on the actual mechanical process behind the strategy.
So, why is this highly effective approach so incredibly boring? Well, a lot of new traders genuinely believe that a good strategy has to be complicated. They think, if I have 5 different indicators on my screen, I must have a better edge. But more information doesn't always mean better information. Usually, it just leads straight to analysis paralysis. This strategy takes a totally different path. It feels tedious because it completely pivots your focus away from that adrenaline rush of chasing money, and instead, it forces you toward mastering a mechanical, highly disciplined process. And remember, simple does not mean easy. It requires an incredible amount of self-control.
Okay, let's dive right in. Here is our agenda for today. First up, the hype versus reality. Then, the boring framework, the survival guide, the filters, and finally, backtesting and mindset.
Starting things off with Section 1, the hype versus reality. To get us totally grounded, let's just clearly define what scalping actually is. It's a short-term trading style where you're attempting to capture relatively small price movements over a really short period of time. Your goal here isn't to ride a massive multi-month market trend. You're looking for a very specific opportunity, and you might hold a trade for just minutes or even seconds. Now, because you're trading so frequently, your real-world costs have a massive, massive impact. Spreads, commissions, slippage, these things matter immensely. A strategy that looks perfectly profitable in hindsight on a static chart, it can perform completely differently in a live account where execution isn't always absolutely perfect.
You can clearly see the fundamental difference between these two mindsets. Over on the amateur side, it is completely cluttered with conflicting indicators. You know the feeling. One line says buy, another says sell, a third says wait, and all of that ultimately just leads to emotional, panicked decisions. Contrast that with the pro mindset, which is just entirely focused and minimalist. A pro relies purely on price action, market structure, key levels, and rigid risk management. You aren't burning your mental energy trying to decode 10 different indicators. You're simply reading what the market is actually doing in front of you.
Moving right along to Section 2, the boring framework.
All right, our very first rule is simple. Never, ever fight the market structure without a highly specific reason. First, we absolutely have to understand what the broader market is doing. If an asset moves from $100 up to 105, pulls back to 102, and then rips up to 108, that is a classic uptrend structure. It's making higher highs and higher lows. Constantly trying to short the market in this environment, that puts you completely on the wrong side of momentum. On the flip side, if the market is steadily making lower lows and lower highs, you've got a downtrend structure. This boring strategy demands that we align our directional bias with these basic structures before we even think about clicking a button.
So rather than just blindly buying the dip because it hit some imaginary support line, we follow these 5 precise mechanical steps. Step 1, identify that broader trend. Step 2, locate a key level where the price has actually reacted in the past. Step 3, wait for the price to get there and watch the reaction. Do buyers actually step up and defend the area? Step 4, you wait for a predefined confirmation, like the price breaking a nearby swing high. And finally, Step 5, the actual entry. Do you see the difference there? You are responding to what the market just did, rather than arrogantly trying to predict what it's going to do next.
Which brings us perfectly to Section 3, the survival guide.
Okay, here is a hard truth you just have to accept. You can have a phenomenal entry. You can perfectly identify the trend, pinpoint a beautiful level, and guess what? You can still lose money. That is simply the reality of trading. So before you enter any trade, you must know exactly where your stop loss is going and precisely how much money you are willing to lose. Your position size has to come from your predefined risk. It should never, ever come from sitting there asking, wow, how much money can I make on this one? If your trading plan allows you to risk exactly $100 on a trade, that defined risk strictly dictates how many shares you are allowed to buy, period.
And ignoring that rule leads us directly to the emotional death spiral that destroys so many accounts. It goes like this. A trader loses $100. They get frustrated, maybe even a little personally offended by the market. So what do? They take another trade, but this time they double their risk to $200. And then they lose again. Suddenly, sheer panic sets in, and they try to make it all back in one shot by increasing their position size yet again. Listen, the market does not care that you lost money on your last trade. A professional looks at a loss, shrugs, and simply says, next trade, same risk rules. Is it boring? Yeah, absolutely, but it literally keeps you in the game.
Let's move to Section 4, the filters.
Even if a setup looks completely flawless, it can still fail. And that is exactly why we need exclusion rules, which we call filters. Knowing when not to trade is a superpower. You have to sit on your hands when the market is extremely choppy and directionless. You absolutely avoid trading when spreads are unusually wide because they'll just eat your profits alive. You stay flat during major news releases, stuff like Federal Reserve announcements or CPI inflation data, where volatility can cause massive slippage and completely unpredictable price spikes. And finally, you stop trading immediately if you realize you are on an emotional tilt. Extreme discipline means protecting your capital when conditions are bad, even if it means sitting staring at your screen for 2 straight hours without ever clicking your mouse.
And that leads us to our final part, Section 5, Backtesting and Mindset.
Look at this comparison. This completely shatters the illusion of the win rate that so many beginners obsess over. Check out Strategy A. An 80% win rate sounds amazing, right? But look closer. The average win is a measly $50, while the average loss is $300. Literally, just a couple of bad trades will completely wipe out dozens of hard-earned winners. Now look at Strategy B. It only wins 45% of the time. Think about that. You were actually wrong more than half the time. But the average win is a solid $250, and the average loss is strictly capped at $100. Strategy B is the one that actually makes money over time. It's the one with positive expectancy.
And because of that brutal mathematical reality, you must collect historical examples and rigorously backtest your plan. When you do, these are the metrics you have to track over a really large sample size. We're talking win rate, average win, and average loss. But beyond that, you need to track your maximum losing streak and your maximum drawdown, just so you know exactly what kind of emotional pain the system is going to put you through. And definitely don't forget to factor in your trading costs to find your true overall expectancy. Look, judging any trading system based on a sample size of just 5 trades is a total recipe for disaster. You need hard, cold data.
All of this brings us to a quote from the source material that just perfectly captures the entire ethos of what we've discussed today. Don't copy someone's profit, copy the discipline behind their process. Remember that flashy $22,000 clickbait number we talked about at the very beginning? Your goal should never be asking how you can magically make that exact same amount. You have no idea what their account size is, what their exact fee structure looks like, or what kind of gut-wrenching drawdown they had to sit through. The only thing genuinely worth emulating from a profitable trader is the boring, relentless discipline they use to execute their predefined plan day in and day out.
So as we wrap up this explainer, we leave all that online hype behind, and we end with this final provocative thought. I want you to abandon all the flashy promises and ask yourself the only question that actually leads to long-term profitability. Can I build a strategy with positive expectancy, ruthlessly control my risk, and actually follow my own rules consistently? It's not about trying to predict every single candle on the chart, and it is definitely not about getting rich overnight. Honestly, sometimes the single biggest advantage you can possibly have in the markets is simply having the discipline to wait for the right conditions. I challenge you to look closely at your own trading process today and ask yourself, are you willing to be this boring?